Welcome back to NWR's Vantage Point Conference, which up next we have a bit of an open panel discussion, a chat with Nick Lytle from LSN Capital, someone who I've known for probably 15 or 20 years. Did the Oxfam Trail Walker together some 11 years ago, probably one of the most painful things that I've ever done, and probably for Nick as well. But before we get into a bit more of a discussion around specific stocks and different things, Nick, perhaps you could just give us a bit of a background around LSN. How long has it been around for? What's the focus and what attracts you to small caps?
Thanks, Simon. Thanks for having me. Always love chatting stocks and markets with you. So LSN's a Melbourne-based fund manager. We run one fund which specialises in small caps, and the way we define small caps is companies that are outside the top 100. So we launched this fund in 2021. Like many of the companies that we invest in, we're in ramp-up phase across our business and also across FUM and business development. So that's been a real focus for us as a business. But on the investment side of things, our key focus is those stocks outside the top 100. And the reason we do focus on that is over 15 years of experience, we've found that the best growth opportunities come from that cohort in that space. And also access to management is also really key within our investment process. And we just find access to companies and to founders is very much applicable and very much available in those businesses that are outside the top 100. I guess if we look at the conference that NWR got on the last couple of days, we can see that as a real opportunity to get in front of small companies. We can see the founder, we can meet the founder, and we can basically sniff out ideas in that small cap space. So I guess the key opportunities for us is growth, access to growth, and access to management.
Helps knowing someone in IR who can organise meetings with those sort of companies as well.
One of the best, Simon.
Just a little plug. You talked about the conference. Obviously, there's some 40 companies which are presenting, some of which are smaller and relatively illiquid. Can you talk us through how you sort of look at liquidity and what sort of is that an opportunity? Is it an impediment? How do you sort of look at that?
Yeah, so maybe if I just take you through what we look for in a business and how we approach stock picking in a sense, that might help, and then I'll go into the liquidity. So for us, we really focus on earnings growth and sustainable earnings growth. That's what we're looking for. We know that share prices follow earnings over the long term. So if you can find businesses that can sustainably grow their earnings over the long term, the share price will follow. And for us, the key is sustainability. So we really dig deep onto the sustainability of the business and the earnings growth. And we have measures that we look at, and 3 of them are quantitative and 2 of them are qualitative. So we look at margins, balance sheet, and the return profile of the business, and that gives us a good understanding of the economics and the drivers behind the growth. But then we look at valuation and management. And so if we pull out management, for example, it's so key to driving that long-term earnings growth. And as business owners ourselves, plus investors in businesses, and also I think if we look at investors looking at funds, essentially investors looking at funds want alignment and track record for the fund manager they're investing in, and we're no different to the way we look at management. So alignment and track record are really key points within our management focus. And the valuation piece also, I guess if we look at markets in the last 18 months, we can see how important it is to pay the right price for a business. Granted, we're looking at businesses that are high quality, got really great runways for growth, and so valuations rarely get cheap in an absolute sense, but generally we're happy to pay up for good quality companies. So ideally we're looking for companies which can sustainably grow, have a great quality management team, and also a valuation which is reasonable. So if we sort of roll that in towards the liquidity piece, we're really conscious of liquidity. We are a relatively small fund, so we can use that to our advantage, but we also understand cycles in markets and what liquidity plays. And effectively, we view liquidity as a magnifying glass on the outcome for our investments. So if you get it wrong in a liquid stock, it costs you more, and vice versa. So stocks that outperform and do well, and they are liquid, the upside is considerable. And so we allocate a part of our portfolio to that more liquid small cap space, and we adjust that exposure depending on where we are in the cycle effectively. And there's times that you can be looking at this space and there's times that you shouldn't. And so there are periods where this micro cap or liquid space lay dormant. We're in that time at the moment, but equally that presents opportunities, and that presents the chance to get out there and meet companies and see companies and find good businesses that are, illiquid but are performing well, and it gives you a chance to get into these businesses and stocks at a good price.
Yeah, I think, generally, liquidity is obviously horrendous at the moment, but you also just never know when the market takes a shine to some different companies. We'll talk about Duratec later, but I think that's a good example in terms of relatively liquid, unfound, change pretty quickly when earnings follow and more eyes are on the stock as well. Yeah,
and there are, if I look at the space in totality, there is some scorched earth valuations out there. I mean, there are a bunch of stocks that are trading on a negative EV where their cash is greater than their market cap. The key to that is finding the ones that can grow and do not need equity markets or capital markets to fund them from there. But, sifting through the rubble, so to speak, to find these businesses, can be very rewarding, because the risk appetite will come back into markets. People will allocate money to this space again. And that's when your sort of outsized returns come out the back. So it's a space that we are sifting around in. We're looking for ideas, but we have to be selective around liquidity and stock selection.
And just in terms of looking for ideas and whatnot, are you sort of selective of how you spend your time with companies, or do you have a sort of open mind in terms of particularly if it sort of fits the bracket and it's not pre-revenue? Every meeting's a good meeting, sort of thing.
Yeah, we take that approach around meeting companies, networking across the investment landscape. Obviously, we've been in markets for 20 years, myself and my business partner. So between us, we have an extensive network. But there's never a bad meeting. There's always something you can learn. There's, you might learn something about the sector that you're already invested in, but generally there's always something to learn, something to garner. And there is often we have what we call a bench, stocks that we've met, we like, we're still waiting for a catalyst, we're still waiting for some other things to fall into place before we'll invest in it. But it's always good to meet them, keep abreast of what they're doing and any changes that are going on in that front. And like you say, there are businesses out there in this space that are doing well, that are ticking boxes, but share prices aren't responding just purely because of liquidity. And that is an opportunity.
It dovetails reasonably nicely into an NWR client, which is just in January. Again, another nice self-plug, but Accusensis, they listed underwater. Is that something that you'd look at? And have you looked at it before?
Yeah, well, we have met Accusensis. I'll just don't really want to give a 101 on the business, but effectively they have the technology that is the cameras that catch you on your mobile phone and you're speeding while you're in the car. So when we saw the company, we were impressed with the level of growth. I mean, effectively, a standing start 5 years ago to delivering $40 million of revenue by commercializing a product that is unique in the market, in the sense that the camera technology is unique. So that growth profile is attractive. It's founder-led. Again, that's a big tick for us. And also, importantly in this space is the cash and the pathway to profitability. So $25 million in the bank, free cash flow positive potentially next year. That gives them more than enough runway to fund themselves on the growth path. So we were impressed with the business. We don't own it at the moment, but something we're watching, and we were impressed. And those three characteristics definitely pique our interest and warrant more work, and keep an eye on it and just follow the progress.
And in terms of, I think they've upgraded twice since being listed. They're still underwater. What do you sort of see for the reasons as to why stocks like this aren't moving when they're delivering?
I think liquidity is one issue, but I mean, if you look at the market is pretty nervous at the moment. It's grappling with a slowdown in economic cycle, and what managers and investors do is they grab all the financials from businesses that are listed, and they try and estimate and make predictions around the performance of these businesses in slowdowns. And so for businesses that have been listed a while, there is a track record, there is tangible evidence of performance during slowdowns, and new listings don't have that look through. I mean, in this case, the business, had only been around for 5 years also. So I think being a new listing and having lack of track record is one part of it, and also just the appetite for loss-making businesses also is definitely not around at the moment. So those combination of those two things has probably impacted on the stock performance, really. So
that makes sense. And we touched on Duratec earlier, and LSN supported Duratec for some time. Speech in the AFR, I think around September last year. It's a regular feature in the LSN monthly, given its performance. Can you just talk to us originally what attracted LSN to a stock like Duratec?
No, sure. I mean, this has been a great investment for us, really. I mean, you shouldn't fall in love with stocks, but this has been very, very good to us over the journey. And I guess ironically, they were relatively new to the market, and we were relatively new in setting up our business when we met them. So there was quite a nice synergy between what we offered and what they offered. But I mean, if we look at what we're attracted to, I mean, it was founder-led, which was a massive plus for us. History of growth. I mean, it only been listed for not that long, but prior to that, the founders have been in the industry a long time, and they delivered lots of growth. And the valuation at the time was I mean, it was crazy, really. It was on 3 times EV. Half the market cap was in cash, and they were profitable. Granted, there was some, I guess, some headwinds and some disruption from COVID, but what really sort of got us over the line and gave us comfort was just meeting management on multiple occasions, and that they're always available, they're always transparent with any questions, and they delivered to what they said they would. They exceeded expectations, and that gave us comfort. So the history of growth, the founder-led, and evaluation that gave us a really great safety net, in a sense that some protection on the downside there. So and as it turns out, they've delivered in spades, exceeded expectations for over 18 months, and the market's had, I mean, the stock has re-rated and had earnings upgrades. So that's the nirvana in investment, really, finding those businesses that can re-rate and deliver above expectations.
Just obviously, I think it was probably around 45 cents when it was featured in the AFR. It's now sort of trading about $1.10.
Yeah.
How do you manage that sort of, it's you don't want to sell them too early, but you don't want to be caught holding the baby, when something potentially might falter or whatnot. But how do you manage a position like Duratec when it's rallied and performed as hard as it has, in the last 12 months?
Yeah, that's a good question. So it's about risk, really. I mean, we still like the business. We still think it can exceed expectations, and the valuation, remains attractive. But as you say, things happen. It's a listed company. There's volatility in markets, and we don't generally like to take positions up too big within our portfolio. We wouldn't let run up to 10% of our portfolio, but effectively we let the performance. I mean, we've been managing sort of cash flow within our fund as well, which kind of skews the, I guess, portfolio management skill. But we effectively let the performance of the stock increase the weight to a certain point, and then we maintain that weight as the stock goes up. So effectively, we don't let it run to too big a position within our portfolio, but big enough to still make a meaningful contribution.
No, that makes sense. Yeah. And in terms of the order book and pipeline of something like Duratec, how integral is that from a forward-looking evaluation?
Yeah, it still remains very important, because as the business grows, the more work required for it to stand still. They have contracts rolling off, they need to replace them, and as their pipe grows, then they need to fill that. So that is important for us. But we also see their balance sheet as an opportunity to grow that via acquisition. they can enter into new markets as well. So that also broadens out the scope for work to be completed. And so, yeah, it's still important. We still look at it, but we think there's sort of multiple levers they can pull to build out that pipeline.
Just had a question come in, sort of fits into the discussion as well. What does the portfolio look like at the moment of LSN, and are you looking to change it soon? What's the sort of percentage cash that you're holding at the moment?
So we generally run cash levels between 0 and 10%. I mean, our view is that we're in the business of picking stocks and investing in businesses, not trying to time the market, but we have a little bit of cash there available for opportunities that come up. We are relatively optimistic on markets given where we are in the rate cycle, but within that, there are exposures and sectors that we prefer rather than, and there are some that we're avoiding at the moment. As you've seen this month, there's been a lot of earnings updates. We feel like we're in that sort of window of earnings risk, especially from the consumer, given we've seen some stocks within the consumer space and even some of the domestic travel space reporting a bit of a slowdown. So we're looking for businesses that we think can grow during the next 6, 12, 18 months, 2 years, and that can get through the cycle with a growth tailwind or a growth execution. So businesses that are relatively immune to the economic cycle, have really strong balance sheets and great management teams that can drive them through this difficult period, and less exposed to cyclical stocks that are really exposed to the consumer or the cycle, so to speak. But having said that, we're of the view that the next 6 months will be the time to increase our weight to those quality cyclical businesses that will come out the other side, that have got the balance sheet and the management team to navigate this difficult period. So like in that space, we had an update from Lifestyle Communities yesterday. That's a high quality business. And we think that, these levels are representing a great opportunity to start increasing our weight to that one.
Right, thanks. Spoke about, between you and the other Nick, there's 20 years odd experience there. You've been a number of fund managers before. You've obviously built up, a number of contacts, networks, around the industry and whatnot. How reliant are you on those versus finding or generating your own ideas?
Oh, look, we definitely use our network as best as we can to get out there and speak to as many people as we can. I mean, that's sort of part of the process of valuing a business and inputting the data, I guess, into our investment approach. You want as many data points, you want as many angles as you can to analyze a business and understand how it operates. And so speaking to as many people as you can, using a network within markets, within investor relation firms, within other businesses, within the investment network is really important. We speak to competitors, we speak to unlisted contacts, speak to private equity businesses that own businesses within sectors we look at. All the data is useful, and it goes a long way to understanding the business and trying to project the outlook for each of these businesses.
Perfect. And I saw last night in the AFR, the old Think or Nido childcare centres are looking at a second half listing. Floats and IPO market is basically frozen at the moment. What's your sort of view on the IPO market, and what sort of needs to change in terms of defrosting that?
Look, obviously it's been a tough space for IPOs, and it will remain tough while the market is where it is. I would say though that IPOs that do get through this process during really tough markets can prove to be great businesses, purely because of the supply demand dynamics, where if there are enough investors to put their hand up, then there's a lot of work that's been done and people are risk averse. So looking at those businesses can be rewarding. I think you just need sentiment to turn. You need a clearer picture on the economic outlook, which I think we will get in the next 3-4 months as rates go on hold. The cycle plays out and the market can effectively wrap its arms around the cycle. Like, we're in the final phase of earnings downgrades, we're in the final phase of rate rises, the market just needs to sort of see where, say, from an economic point of view, where housing settles, where unemployment settles, where rates settle, and then markets look forward, they'll look through that and start pricing in rate cuts and a bounce in economic activity. So I think once that plays out, there'll be more activity on the IPO pipeline. And I guess the other thing to look at is M&A in markets and in around sectors and industries, and when those M&A targets will be recycled back into the market. I mean, there's a lot of M&A last year in stocks that have been beaten up, and you might find them re-emerge in periods to come back onto the market. And private equity are obviously very cashed up as well, looking for targets. And that, I think, part of the sort of reticence maybe on their behalf is just waiting for rates to settle, so then they can understand the economics of deploying that capital. But that will definitely play out in the months ahead.
That's a good summary. Nick, thanks so much for coming on. Thanks for all those joining. If you did want to find out more about LSN Capital, website is lsncapital.com.au. But Nick, thanks very much for joining.
Thanks, Simon. Always good.
Thanks for helping me out the hill as well.
All right, thank you.
Thanks, guys.